Hello viewers, so welcome to my channel. I am Hasham Ali Khan. So far we have done the problems on working capital, cash management, receivables management. In this video, I am going to explain you the important problems on inventory management. Inventory is one of the important part of current asset. So it is a component of working capital. So in order to manage the working capital, proper management of inventory is mandatory, compulsory. Without managing the inventory, we cannot be able to manage the working capital. So what is inventory and what are the techniques for managing the inventory? Already I have uploaded the video, theory video on inventory management. In this video, I am going to explain you the problems on inventory management. So if you have not watched the earlier video of inventory management, you go to the playlist of my channel, select the subject financial decision making, select the video of inventory management theory explained. Watch that video without coming to this video, because without having the knowledge, theoretical knowledge of inventory management, you should not go to the problems. So before starting the next problem, in this video, 4 problems I am going to explain you on inventory management. The problem 24, 25, 26, 27. So before starting the problem, I expect my viewers to have a printout of the problems, which I have given in the link under my description. Always keep ready the problem. Take the screenshot of the solution of these 4 problems, then I'll explain all the points in detail. Come on, see the 24th problem. Every year, companies' demand for spinning tops is 15,000. The annual requirement of spinning tops is 15,000. The ordering cost, once factor is in the cost to create, place, validate, track and receive orders for rupees 20 per order. Simply, ordering cost is rupees 20 per order. Finally, the holding cost for each is spinning top, including rent, storage space, insurance, etc. 50 paisa, 0.50 rupee per unit. Calculate EOQ. It is asking you to calculate economic ordering quantity. This is the most important technique of management of inventory. What is the meaning of the term EOQ? Economic order quantity means that quantity of order, that quantity of a number of units to be placed to the supplier each time, so that the inventory cost should be minimum. The objective is the investment in inventory should be minimum. So what is the ordering quantity to be followed every time when we make the order to the supplier, so that the inventory cost should be minimum? So what is the inventory cost? Purchase cost of material plus carrying cost plus ordering cost. So I suggest you always to keep a notebook beside you. Whenever I give the explanation, you should write down immediately. Then only you can be able to remember. Otherwise, we'll forget it. Simply watching the video will not serve the purpose. Write it down, the points which I'm explaining. So inventory cost consists of ordering cost and carrying cost. Ordering cost is the cost when orders are placed with the supplier, and carrying cost is the cost of holding the inventory in the stores. When inventory is held in the stores, rent charges, insurance charges, interest charges, deterioration charges, all these are the expenses attached with holding the inventory. There is inverse relationship between ordering cost and carrying cost. If you keep more ordering cost, that means we are placing more number of orders. Ordering cost will be more, but carrying cost will be less, because we are holding a small quantity of material. Right? So when ordering cost is more, carrying cost will be less. On the other hand, if ordering cost is less, for example, we are placing only 1 or 2 orders, not more than that. We are purchasing in bulk quantity only once. So ordering cost will be less, but carrying cost will increase, because we are holding a huge inventory in the stores. So what will happen? Carrying cost will be higher. So inverse relationship exists between ordering cost and Carrying cost. So how to balance it, how to minimize it, the EOQ will explain. So in this problem, I'm going to find out how much is the EOQ. So economic order quantity EOQ. The formula is 2CO by I under root, where C stands for annual demand or annual usage or annual consumption. So how many spinning tops we require per annum given in the problem? 15,000 units. Then ordering cost per order is given in the problem 20 rupees. And the carrying cost per unit per annum. What is the carrying cost to hold 1 unit for 1 year? It is given 0.50. These three things are required for calculating EOQ. Now we substitute the values in the formula. So EOQ is equal to 2. 2 is already there in the formula. Into C. C is 15,000. In place of C, 15,000. And ordering cost is 20 into 20. Divided by carrying cost. The carrying cost is 0.50. Now multiply 2 into 15,000 into 20 divided by 0.5 under root. You will get 12 lakh rupees under root. So after root you are getting 1095.45. If you round it off, it will be 1096. This symbol is equivalent because we cannot place for fractional units. The units should be in whole number. So we make it equivalent to 1096 units. This is the EOQ. That's all. It is asking you to calculate EOQ. But apart from that, how many orders to be placed in 1 year? For your knowledge, for your information, I am calculating. Otherwise, in the problem, it is not asking. It is asking only EOQ. Now, number of orders to be placed every year. The formula is annual requirement divided by ordering quantity. Annual requirement is how many units? 15,000. And ordering quantity, how much ordering quantity is there? 1096 units. So 15,000 divided by 1096, you will get 13.69. Again, number of orders cannot be in fraction. So we can round it off. 13.69 can be made as equivalent to 14. The number of orders to be placed each year is 14 orders. Every time, whenever we place the order, we place 1096 units. That's all. This is the end of problem number 24. Now, see the 25th problem. A manufacturing company places a semi-annual order of 24,000 units at a price of 20 rupees per unit. Semi-annual means every 6 months. In a year, 2 times. So 2 times orders are placed, 24,000 units per order. So every 6 months, 24,000. So in 1 year, 24,000 plus 24,000. 48,000 is the annual requirement. So presently the company is making 24,000 every 6 months. So at the selling price of 20 rupees per unit, its carrying cost is 15% and the ordering cost is 12 rupees per order. Ordering cost is given 12 rupees, but carrying cost we have to calculate 15% of cost per unit. The cost per unit is 20 rupees. So 15% of 20 rupees, you will get 3 rupees. 3 rupees is the carrying cost per unit per annum. What is the most economical order quantity? That means EOQ. The first question is asking you to calculate EOQ. Secondly, how many orders need to be placed in a year? Just like the previous problem. Number of orders to be placed. Specifically, it is asking you to calculate this. In the last problem, it was not asking, but for our information, we have calculated. Now it is asking. That's all. Now, see carefully. Most economical ordering quantity EOQ. Formula 2CO by I under root. C is equal to annual usage. Presently, the company is placing semi-annual order. Semi-annual order means 2 orders in 1 year. Every 6 months, 1 order. The first 6 months, an order of 24,000. Next 6 months, an order of 24,000. The total number of units ordered in 1 year, 48,000. So 24,000 units into 48,000 is the annual requirement. O stands for ordering cost per order, that is given in the problem, 12 rupees. I is equal to carrying cost per unit per annum. It is given 15% of cost per unit. The cost per unit 20 rupees. So 15% of 20 rupees, it comes to 3 rupees. Over. Now simply you substitute the values in the formula of EOQ. 2 into 48,000. C is 48,000. O is 12 rupees and I is 3 rupees. So 2 into 48,000 into 12 divided by 3, 3,84,000 under root. So after root, you are going to get 619.68. So equivalent to 620 units. Because the number of units cannot be in fraction. It should be in whole number. So we can make it equivalent to 620 units. So one answer we got EOQ. The second question is asking a number of orders to be placed in 1 year. The formula is annual requirement divided by ordering quantity. Annual requirement is 48,000 and the ordering quantity is 620 units. So 48,000 divided by 620, you can see here. 48,000 divided by 620, 77.42 orders. Again, orders cannot be in fraction, so we can round it off, equivalent to 78 orders. So the second answer is, in 1 year, 78 orders should be placed. Each order, the quantity should be 620 units. That's it. This is the end of 25th problem. Now, see the 26th problem. Ambani Brothers has been purchasing an item in lots of 900 units. So this company, Ambani Brothers, is placing an order every time. Whenever it places an order, it will place 900 units. And this equates to 3 monthly supply. 3 months supply is 900 units. So every 3 months they are giving the order for 900 units. So every 3 months means 1 year. How many months are there? 12 months. So 12 divided by 3, 4. 12 divided by 3, 4. So 4 orders are placed in 1 year. And every time they are ordering 900 units. So 900 into 4, 3,600 units is the annual requirement. So annual requirement not directly given in the problem. Indirectly it is saying 3 months quantity is 900. For 12 months how much? So 12 divided by 3 into 900. You will get 3,600 units. Then the cost per unit is 12 rupees. And the ordering cost is 16 rupees per order. And the carrying cost is 25% of cost per unit. The cost per unit is 12 rupees. So 25% of 12 rupees is 3 rupees is the carrying cost per unit per annum. Required. How much can Ambani Brothers save per year by purchasing the item in the most economical quantities? Presently, Ambani Brothers is not following EOQ. They are following a different policy. The policy is every 3 months they are placing an order for 900 units. That's it. This is not an economic policy. If they follow this policy, what will happen? The inventory cost will be more. So in order to minimize the inventory cost, we should not follow this policy. We have to follow EOQ policy. So first of all, we will find out what is the EOQ, right? See here. EOQ formula 2CO by I. C stands for annual requirement. It is not directly given annual. So we have to calculate 900 into 12 by 3. Because for 3 months 900. For 12 months how much? So 12 by 3 into 900. You will get 3,600 units. This is the annual requirement. O, ordering cost per order, 16 rupees per order given. Carrying cost is 25% of the cost per unit. The cost per unit is 12 rupees. 25% of 12 rupees, 3 rupees. Now substitute. EOQ is equal to 2 into C, 3,600 into ordering cost, 16 divided by 3 under root. So 38,400 under root, 195.95 units. So for our easier calculation, we can make it 196 or we can make it 200. 200 will be more appropriate because we have to compare the total cost. So instead of making 196, I am making it equivalent to 200 units. So EOQ. Economic ordering quantity says whenever we place the order, we should place the order for 200 units only. Only 200 units. But according to the present policy, they are placing an order for 900 units. That means the present policy is entirely different from the EOQ. Right? Now present ordering quantity is 900 units. But EOQ says 200 units. Now we want to compare what is the inventory cost we are incurring presently and what is the inventory cost it will incur at EOQ. So here statement showing total inventory cost at present policy and EOQ policy. In a tabular form I can calculate, easily we can calculate what is the inventory cost according to present policy and according to EOQ policy. An inventory cost consists of two costs, that is ordering cost and carrying cost. The ordering cost plus carrying cost we have to calculate at both. Now first of all, ordering quantity. Present policy, the ordering quantity is 900 units. If you follow EOQ, the policy is the number of units are 200. Next, ordering cost. The formula for ordering cost, number of orders in a year into cost per order. Remember the formula, write it down there itself. Ordering cost, number of orders into cost per order. So how to calculate number of orders in a year? Already two problems we have applied. Annual requirement divided by ordering quantity. Annual requirement divided by ordering quantity. You will get number of orders. So annual requirement divided by ordering quantity into cost per order. So present policy 3600 annual requirement, ordering quantity is 900. See here. Present policy 900 into cost per order 16 rupees. So 3600 by 900 into 16, you will get 64 rupees. In the EOQ policy, 3600 divided by 200. See here, what is the ordering quantity? 200. So 3600 by 200 into 16, 288. So compare. Presently, we are having ordering cost of 64 rupees. But if we follow EOQ, the ordering cost is coming to 288. But don't jump to the conclusion that in the present policy ordering cost is less. The present policy is better. No. Apart from ordering cost, one more cost is the carrying cost. That we calculate. So carrying cost. The formula for carrying cost, average inventory into cost per unit into percentage of carrying cost. Here I have written the formula. Average inventory into cost per unit into percentage of CC. CC stands for carrying cost. Average inventory. How to find out average inventory? The ordering quantity divided by 2. So what is the ordering quantity here? 900 units. So 900 divided by 2. Here you can see 900 divided by 2 into cost per unit. The cost per unit is given in the problem 12 rupees per unit. So 900 by 2 into 12 rupees into percentage of carrying cost, that is 25%. Already we have taken here. So 25%. So 900 by 2 into 12 into 25%, you will get 1350. 1350 is the carrying cost we are incurring at present policy. Now EOQ policy, 200 divided by 2. Ordering quantity is 200. So 200 divided by 2 into 12 into 25%. It comes to 300 only. So we can see, we can compare here. The carrying cost is very, very high in the present policy. But carrying cost is coming down to 300 rupees only in the EOQ policy. Now we take the total. A is the ordering cost, B is the carrying cost. Add up A plus B. So 64 plus 1350, you will get 1414. 1414 is the total of ordering cost and carrying cost we are incurring at present policy. If we follow EOQ policy, 288 plus 300, it is 588. That's all. Now easily you can compare the total cost. 1414 is the total cost in the present policy and 588 is the total inventory cost in the EOQ policy. By comparing this, now you come to the conclusion which policy it is better. Present policy is better or EOQ policy is better? EOQ policy is better. Because our inventory cost is very, very less, 588 only. So how much the company saves by following EOQ? That is the ultimate question in the problem. So in the problem it is given how much the company saves if we follow EOQ. So simply subtract 1414 minus 588. The money that could be saved by implementing EOQ is 1414 minus 588, 826 rupees the company can save by following EOQ. That's it. This is the end of 27th problem. Now next to 28th problem. The National Sports Company purchases tennis balls at rupees 20 per dozen from its supplier. Suppose our company is National Sports Company. We are purchasing tennis balls from one of the supplier. And the supplier is charging 20 rupees per dozen of tennis balls. The National Sports will sell 34,300 dozen of tennis balls evenly throughout the year. Requirement. Annual requirement 34,300 dozen of tennis balls. The total cost to handle a purchase order is 10 rupees. This is the ordering cost. Ordering cost to 10 rupees. The insurance, GST and rent for each dozen tennis balls in the average inventory is 0.40. That means the carrying cost. The carrying cost is insurance, GST, rent, etc. combined together 40 paisa, 0.40 per dozen. The company wants a 5% return on average investment inventory. So on the average investment in inventory, 5% is the return. So what is the cost per dozen? 20 rupees. So 5% of 20 rupees is 1 rupee. 5% of 20 rupees is 1 rupee. So 1 rupee is the carrying cost plus 40 paisa is also carrying cost. So carrying cost includes rent, GST, insurance plus return on investment. So 40 paisa plus 1 rupee. So 1 rupee 40 paisa is the carrying cost. Required. Compute the economic order quantity. First question you are required to calculate EOQ. Second question, compute the total inventory expenses to sell 34,300 dozen of tennis balls if orders are placed according to EOQ. That's it. Now see carefully. First of all, it is asking you to calculate EOQ. First part. EOQ is equal to 2 CO by I. C is equal to annual usage 34,300 given in the problem. Then O, ordering cost per order 10 rupees given in the problem. I is equal to carrying cost per unit per annum. 40 paisa is the insurance, GST, rent, etc. 40 paisa per dozen of balls. Plus 5% on the investment made in inventory. So what is the cost per dozen balls? 20 rupees. So 5% of 20 rupees. It comes to 1 rupee. So 0.4 plus 1, 1.40 is the carrying cost per unit per annum. Now EOQ is equal to 2 into 34,300 into 10 rupees ordering cost divided by 1.40 carrying cost under root. So 4,90,000 under root, it comes to 700 dozens. First question completed. How much is the economic ordering quantity? This company should place an order of 700 dozen of tennis balls every time. Whenever it places the order, it should place for 700 dozen. That's it. Second question, total inventory expenses. Actually, when inventory expenses word comes, we include only ordering cost and carrying cost. But here we include purchase cost also to find out the total inventory cost. So purchase cost 34,300 into 20, 6,86,000. In 1 year, 34,300 dozen of tennis balls are required, and every dozen the cost is 20 rupees. So total 6,86,000 is the purchase cost. To this we add ordering cost. Number of orders into cost per order. The cost per order is given in the problem 10 rupees, but number of orders are not given. The formula is annual requirement divided by ordering quantity. Already so many problems we have applied. Annual requirement 34,300 divided by ordering quantity 700. So here 34,300 divided by 700 into 10. 490 rupees is the ordering cost. Now carrying cost. The formula for carrying cost, average inventory into carrying cost per unit per annum. Carrying cost per unit per annum. How much is the carrying cost per unit per annum? 1.40. Average inventory means ordering quantity divided by 2. So how much is the ordering quantity here? 700. So 700 divided by 2 into 1.4, it is 490. So we got the purchase cost, we got the ordering cost, we got the carrying cost. Add up 6,86,980. So 6,86,980 is the total inventory cost including purchase cost. If you don't want to include purchase cost, only 980 rupees is the total of ordering cost and carrying cost. So in this video, I have explained you 4 problems on inventory management. So if you want the complete command, I suggest you don't join in the middle, because if you want the complete knowledge, watch all the videos in sequence, one video with the other video. There's a linkage in all these videos. So till the end, you watch the complete video, not once, twice, thrice, like that. Definitely you will get a lot of command, lot of knowledge, and these videos are very important not only at graduation level but also for post-graduation level, for professional exams like CA, CMA or CS, etc. So inshallah we'll continue the next problem in the next video.